Good afternoon, everyone. Thank you for joining me this afternoon for the superannuation update. My name is Alexandra Plum and I'm a manager in the Superannuation Advisory Division here at Vincent's. I've put my contact details down and I'll share these again at the end of the session. If you have any questions as we go, feel free to put them in the chat box and I'll have a look at them at the end. Otherwise, if you think of anything after the session, I'm also very happy to come back to you. So just before we begin, I'd like to acknowledge the traditional custodians of the land on which we meet today and pay my respects to their elders past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today. So just a message that all information discussed today is factual and general in nature and does not take into account your personal circumstances. So today we'll be covering off on a number of changes and updates that have taken place within the superannuation space. We're going to have a look at some upcoming key lodgement dates and payment deadlines. We'll run through some super measures that are going to take effect from 1 July 2022. We'll have a look at some of the changes in contribution rules and also visit some other rates and thresholds that are going to be updated from 1 July 2022. And finally, we're going to have a look at a few practical issues that we found have been impacting SMSF trustees. So firstly, let's have a look at some key dates and payment deadlines that are coming up. So firstly, on the 28th of July, so next month, that's going to be the due date for super guarantee payments for the June 2022 quarter. And it's also going to be the due date for transfer balance account reports, also for the June 2022 quarter, and that's for self-managed funds that need to report those T-bars on a quarterly basis. Then on the 25th of August, that's the due date for the June 2022 quarterly business activity statement or instalment activity statement if it's prepared by a tax agent or a BAS agent. If your activity statements are not prepared by a tax agent or a BAS statement, they are actually due back on the 28th of July. Then on the 28th of October, so the end of another quarter or the first quarter of the new financial year, we'll be back to reporting super guarantee payments and also transfer balance account reports for the September 2022 quarter. They're both due on the 28th of October. And then lastly, on the 31st of October, that's going to be the due date for lodgement and payment of 2022 self-managed fund income tax returns where they've had prior year tax returns that are outstanding. I will also add here that even though we have passed the lodgement date for the SMSF income tax return for the 2021 financial year, I think it's really important to highlight that if your super fund income tax return is more than 2 weeks overdue, then the status of the fund is going to be updated to regulations details removed, and that's on the super fund lookup government website. So when the fund has this status called regulation details removed, the SMSF isn't going to be able to accept any contributions or rollovers via the SuperStream system. So this can be quite problematic for your employer who is trying to make your super guarantee contributions through their payroll system and through SuperStream. Not only is it going to prevent the super fund from being able to receive your contributions as a result of the income tax return not being lodged, but it might also cause your employer to have late lodgement of their super guarantee and they could face penalties as well. So it is really important to try and keep up to date with the lodgement of the return because there's such a short window before those that status of the fund is changed. Okay, so let's run through some new and continuing superannuation measures that are going to take effect from 1 July 2022. Firstly, one of the continuing concessions that's following on from the previous financial year is the temporary reduction in the minimum pension drawdowns. So if you recall, this was introduced by the government way back in March 2020 as a result of COVID relief to try and assist trustees and members to keep as much wealth as possible inside of super. So this concession was due to end on the 30th of June 2022, but the government announced a couple of months ago that the temporary reduction was going to continue on for another 12 months and end on the 30th of June 2023. So the reduction allows members to only need to withdraw 50% of what they would normally have to take for their minimum pension percentage, which is based, as you can see, on age. Just a reminder here, though, that this temporary reduction doesn't apply to defined benefit pensions. So that's your lifetime complying pensions, flexi pensions, or life expectancy pensions. So as an example of how this works, if you're aged under 65 and you are on an account-based pension, you'd normally be required to withdraw the 4% of your member balance in order to meet your pension requirements. Continuing for the next 12 months, the reduction only requires you to withdraw 2% of your member balance. Now, of course, members are entitled to take more than their minimum if they wish to. So currently, Super Guarantee is 10% of an individual's salary or wages. And so from 1 July 2022, this rate is going to increase to 10.5%. And that's going to continue to increase as per the government's plan until it reaches 12% by 1 July 2025. So currently, an individual needs to earn at least $450 per month in order to be eligible to receive Super Guarantee contributions from their employer. But now from 1 July 2022, this minimum income threshold is going to be removed. So that means from 1 July, employers are going to be obligated to pay Super Guarantee contributions even for casual or part-time employees that are earning less than $450 per calendar month. Now, the only exception to this is for employees under the age of 18, and they generally need to work more than 30 hours a week to be eligible to receive Super Guarantee contributions. So with this Super Guarantee increase, individuals with effective salary sacrifice arrangements in place, they're going to need to ensure that they don't breach their concessional contribution cap due to this Super Guarantee increase. Noting that an effective salary sacrifice arrangement can only relate to income that an individual will earn in the future. So now is a really good time to review any salary sacrifice arrangements that you have in place and maybe look at making some adjustments for the 2023 financial year. So let's look at what's new in the world of super contributions. So firstly, I just thought I'd put up a snapshot here of where we're going and also where we've been, because there have been some changes across the last, one financial year behind us and one financial year ahead of us. I suppose to focus on here for those who are still planning to make contributions before 30th of June, so before the end of the 2022 financial year. Just a reminder that your work test age is 67. So if you're aged between 67 and 74, you need to have met the work test in order to make any type of voluntary concessional contributions or non-concessional contributions. And you also needed to have met that work test before the contribution can be made. If you're thinking of making any downsizer contributions, you need to be 65 or older in order to be able to make one of those, as well as meet the other eligibility requirements. And I'll run through those a little bit later. For the current financial year, the concessional cap is $27,500 if you weren't already aware, and the non-concessional cap is $110,000. Now, just keeping in mind with your non-concessional contributions, your total super balance at 30 June 2021 needs to have been less than 1.7 million in order to be able to make those non-concessional contributions. So firstly, let's look at some changes now that are going to be taking effect for the new financial year in terms of contributions. So the biggest change that is going to be happening in the contribution rules is the revocation of the work test. So right now, as I'd mentioned just before, individuals aged 67 to 74 can only make voluntary contributions to super if they worked at least 40 hours over 30 consecutive days in a financial year, or they've met the work test exemption. And this work test must be met prior to the contribution being made. So now, from 1 July 2022, the work test will apply to individuals, it's only going to apply to individuals who want to claim a tax deduction on voluntary contributions. So this now opens a whole bunch of opportunities in that the work test is no longer going to apply to non-concessional contributions, spouse contributions, salary sacrifice contributions, CGT contributions, as well as quite a few others. So from 1 July 2022, where we have got a member that's wanting to make that personal deductible contribution, so they're still going to need to meet that work test, they can satisfy that test at any time in the financial year, which in contrast to the current and previous years, you had to have met it before. Now you can make the contribution, but then satisfy the work test after if you're wanting to make those personal deductible contributions. There also is going to continue to have access to the one-off 12-month work test exemption. So this exemption allows individuals with a total super balance of less than 300,000 at 30 June of the prior financial year, and that they had also satisfied the work test in that prior financial year, they're going to be able to contribute and claim a tax deduction for that contribution. So that is going to continue to be available to individuals meeting those requirements. So on to concessional contributions. So the cap is going to remain unchanged at $27,500 for individuals, and that's regardless of your age. Your total super balance is going to continue to have no impact on your ability to make concessional contributions too. So if you are choosing to make personal deductible contributions to super, the requirement to lodge a notice of intent to claim with your super fund, that requirement still exists as well from 1 July. We have of late been fielding a few questions about the validity of the notice of intent and when they should be lodged. So I just thought I'd clarify that in order for the notice to be valid and considered lodged on time, you need to provide the notice to your super fund on or before the date the super fund's income tax return was lodged, and that's the income tax return relating to the year that the contributions were made, or it can be the last day of the financial year following the financial year that the contributions were made, whichever of those two dates is earliest. So in context, if you had made a contribution in May of 2021, you need to have provided your super fund with the notice of intent either before the 2021 income tax return is lodged or before 30 June 2022, whichever of those comes first. Also, if you're intending to roll over monies out of your super fund to another fund, it's very important to ensure that your notice of intent has been provided to that fund that's doing the rollover prior to making that rollover. This is to ensure that the super fund is able to treat the contributions correctly and also calculate the tax correctly. More often than not, the fund will get in contact with you prior to the rollover being made if you haven't lodged the notice of intent. Also, just a reminder that if you exceed the concessional contribution cap, the excess amount will be included in your personal assessable income and taxed at your own marginal rates. So you do have a choice here to release the excess from your super fund, or you can choose to leave the excess contributions in the fund, and then those excess amounts will be counted against your non-concessional contribution cap. Also a reminder that the ATO has removed the excess concessional contributions charge. So that was removed back on 1 July 2021. And that was that additional penalty that they applied for exceeding the cap. So that's gone, which is good news, I think, less penalties. Another important reminder is that some individuals, they might be able to make additional catch-up concessional contributions from prior year caps. So to be eligible to access this contribution cap, your total superannuation balance must have been less than $500,000 at 30 June of the previous financial year. And so the unused portion of the contribution cap, they're available for a maximum of 5 years, after which they're going to start to expire. So for the 2022 financial year, eligible individuals, they can use this catch-up concessional contribution cap from the last 4 financial years. And that means that for individuals who haven't used any of this catch-up concessional cap, in previous financial years, they could potentially contribute up to $102,500. And that's quite a significant tax deduction. I will add, though, that if you are intending to use this catch-up cap, to please ensure that you and your accountant have thoroughly reviewed what your available cap will be, and if possible, independent of what the ATO records are stating, before you make that contribution. The reason I'm saying that is we have found that the ATO records can be inaccurate, especially if the super fund's income tax return or the individual's income tax returns haven't been lodged or are overdue. You're likely to get an inaccurate amount of what you can use for this catch-up cap. So over to non-concessional contributions now. Like concessional contributions, the annual non-concessional contribution cap is also going to remain unchanged at $110,000. If you're eligible, individuals can also choose to trigger the bring forward rule and contribute up to 3 years worth of contributions in 1 year, so being a maximum of $330,000. Now, as a result of the work test being moved, the cutoff age to access the bring forward rule is also going to increase to 75. So an important reminder as well that the amount of non-concessional contributions that you can contribute into super does depend on that total super balance at 30 June of the previous financial year. So as I mentioned earlier, if your total super balance is greater than or equal to the general transfer balance cap, so that is 1.7 million for the 2022 financial year, and it's going to be 1.7 million for the next financial year as well, you're not going to be able to make any non-concessional contributions. And that doesn't matter about what age you are. If that transfer balance cap is over that amount, no concessional contributions. So your ability to use the bring forward rule is also impacted by your total super balance. And this has kind of got a tiered approach as to how much of the bring forward rule you're able to use, depending on what your total superannuation balance is. So if you've got less than 1.48 million as your total super balance, you can use the full 3 years and trigger the bring forward rule, so the full 330,000. If you've got between that 1.48 and up to 1.59 million, then you're only limited to 2 years of the non-concessional cap, so 220,000 for the bring forward rule. And then lastly, if you've got 1.59 million up to 1.7 million, then you're limited to just 1 year of the non-concessional cap. And then, as I said, over 1.7, nothing. So just to wrap up some of the contribution changes, here are some of the other caps that are still available for members to use. So firstly, super co-contributions, they're still around, they're still available to low or middle income earners that make after-tax contributions into super. So if you're eligible, the government is going to contribute up to a maximum of $500. I know, lots of money. The contribution entitlement depends on your income and how much you contribute. So to be eligible, again, your total super balance must be under that $1.7 million transfer balance cap. And to receive the co-contribution, your total income must be less than the higher income threshold. And for the 2023 financial year, that threshold is $57,016. Secondly, the low income super tax offset is still available. It's a government super payment, again, of up to $500. It's there to help low income earners save for retirement. Individuals with an adjusted taxable income of under $37,000 can be eligible to receive this offset into their super fund, and it's a refund of the tax paid on eligible concessional contributions. And lastly, downsizer contributions. Individuals can only make downsizer contributions in the current financial year if they are 65 or older, as I mentioned earlier, at the time of making the contributions, and they have to have satisfied the other eligibility requirements. However, from 1 July 2022, that age is going to reduce down to just 60 years old. So all the other eligibility rules are remaining unchanged, and the maximum amount of the downsizer contribution is also staying the same at $300,000 per person. To give everyone a refresher on what those other eligibility rules are, if you are thinking of making a downsizer contribution. So firstly, the amount being contributed must be from the proceeds of selling your home where the contract of sale was entered into on or after 1 July 2018. Your home was owned by you or your spouse for 10 years or more. The property had to have been your main residence. The contribution must be made within 90 days of receiving the proceeds of sale, and you can't have previously made a downsizer contribution from the sale of another home. So it's just a once-off. Now, what is exciting is the downsizer contributions are not restricted by what your total super balance is. Hooray! However, once the contribution is made, it will be included in the value of your future super balances. So it's really important to have a think if you're wanting to make a downsizer contribution prior to 30 June about whether it's better to use another contribution cap over the downsizer contribution and potentially delay that downsizer to the next financial year. So we'll just run through some changes to other super-related rates and thresholds. So circling back to the super guarantee, the maximum super contribution base for the 2023 financial year has increased to $60,220 per quarter. So this means that employers are not required to pay super guarantee on amounts over this quarterly threshold. The CGT cap, it's also increased to 1.65 million. So reminder, this is a lifetime cap, and it's available to you if you wish to make contributions into super that have arisen from a capital gains event. And it's also met the requirements of the small business retirement exemption or the small business 15-year exemption. As I mentioned earlier, this is another type of contribution where the work test is no longer going to apply from 1 July 2022. So the CGT contributions can be made up to the age of 75. Now, the low rate cap amount, it's also increased to 230,000. Now, this is another lifetime cap, and individuals that are aged between their preservation age and 59 can use this cap to treat lump sum benefits that they withdraw from super as being tax-free all the way up to that $230,000 cap amount. But then any benefits that you withdraw as a lump sum over this cap amount, they're going to be taxed at the 15%. So Division 293, that threshold is continuing to be the same at $250,000. So if your personal taxable income is exceeding this threshold and you've made concessional contributions into super, then you'll be required to pay an additional 15% tax on those contributions, and that tax is going to be levied in your own name. Now, it's good to remember you do have the option to elect for your super fund to pay this additional tax on your behalf. And I'll also add that if you're intending to make contributions under the catch-up concessional contribution cap and your personal taxable income exceeds the $250,000 threshold, then you're going to be required to pay Division 293 tax on all of those concessional contributions that have been made under that catch-up cap as well. And so lastly, the First Home Super Saver Scheme, it's a bit of a mouthful. Currently, this scheme allows an individual to withdraw a maximum of $30,000 of voluntary contributions, plus the associated earnings less tax, from their super fund to fund the deposit of a new home. Now, from 1 July 2022, the maximum amount that can be withdrawn, that's going to increase to $50,000. So all other eligibility rules for this scheme, they're going to stay the same. Also unchanged in this scheme is the maximum amount of contributions that an individual can make each year, and that's going to stay at $15,000 per year. So for someone who's considering saving using this scheme, then there may be still time in the current financial year to make a voluntary up to the $15,000 contribution, as it's now going to take at least 4 years of these contributions in order to reach that $50,000 limit. So a bit longer than the original $30,000 limit. And lastly, just a reminder about your birth date and how it does dictate when you will meet your preservation age. So why is this important? For individuals that have met their preservation age and have satisfied a condition of release, so most commonly like you've retired, then they're going to be entitled to access their super benefits. So from 1 July, individuals that are born in 1963 are going to start meeting their preservation age. So it is always important to remember that. Okay, so onto a few practical considerations or challenges, depending on how you've looked at it, that we have found most SMSF trustees are currently facing. The first of those being SuperStream. So most of you might be aware that from 1 October last year, SMSF trustees must comply with the SuperStream rules if they're wanting to make a rollover to or from their self-managed super fund. Now, all self-managed funds making rollovers using the SuperStream system are also required to use the SMSF verification service, and that's run by the ATO. Now, this verification service is proving to be a little bit of a headache for both trustees and SMSF practitioners. The verification service works by automatically verifying key details of the SMSF, So those details can be the fund's ABN, its tax file number, the tax file number of its members, the complying status of the fund, the electronic service address, other member details, and also the fund's bank account as well. So if this information doesn't match between the self-managed funds and the ATO's system, then what's going to happen is a rollover request is likely to be rejected, or the trustees of the fund are going to be required to provide more documentation and confirm all of these details manually. Now, this can cause significant delays in the rollover process, and that can have a bit of a detrimental flow-on effect in time-sensitive cases. So, for example, if you're wanting to wind up the fund, the holding up of the rollover can be an issue. Or maybe if we're splitting assets from a marital breakdown in the fund and we have to meet deadlines through the court orders, a delay on the rollover through this process can cause some issues. So some examples that we've experienced in our team that are holding up the verification process, some have been around the member's name being incorrect. So if the ATO has the member's maiden name, but the self-managed super fund used the member's married name, those details aren't going to match, immediately going to throw up an error and the rollover won't be able to go through. Just like as well, like I'd mentioned earlier, if the status of the fund is saying the regulation details are removed, so maybe the income tax return hasn't been lodged on time, that's also going to hold up the rollover. Even something as simple as if a rollover request has outlined a certain dollar amount and then the actual physical transfer of cash, that amount is slightly different, then that's also going to throw up issues within the system and the rollover won't be able to proceed. So there are many, many ways that, that this can potentially cause issues. Now, the ATO is attempting to assist trustees to work around some of these issues. One example is the temporary measure that will allow rollovers to be completed outside of the SuperStream system where trustees are having difficulty obtaining an electronic service address. So this relief is only going to be allowed in very specific circumstances. So if you're a trustee that potentially might be in this situation, you'll need to first contact the ATO and seek approval for the rollover to be made outside of the SuperStream system, and you can do this over the phone. If you do have to go through this process, I'd recommend noting down the reference number from the ATO call that you've done once the approval has been given. The reason why is that it's actually a reportable breach of the superannuation payment standards if you fail to comply with the SuperStream rules. So if you get approval through this temporary relief, the ATO call reference number, you can give that to your auditor and then they'll know that you had the appropriate approval. Now, for most people, I should add that if you've got a self-managed super fund, like with us at Vincent's, the software provider that all of the annual accounts are prepared for automatically provide an electronic service address. So you're unlikely to run into this issue and therefore qualify for that type of relief, but it is worth knowing that it is available. Now, another area that I'm sure most people are aware of are director IDs, and that from 1 November last year, all Australian directors are now required to apply for director ID. So this does include individuals that are directors of self-managed super fund corporate trustees. So individuals that were already appointed as a director on or before 31 October last year, they don't have to apply for their director ID until, well, at the latest, by 30th of November this year. I realise it's a little while away, but it will also be here before you know it. And then from the 5th of April, so a couple of months ago, individuals that are appointed as a director for the first time, they're going to be required to apply for their director ID prior to even being appointed as a director. What is very important to note here is if you're one of these first-time directors that's going to be appointed, you need to have applied for your director ID at least one day before you are appointed as a director. You can't apply for the ID on the same day of the appointment. Now, the government body that's going to be overseeing all of this is the Australian Business Registry Services, and they've indicated that director IDs are going to be issued. You can do it instantly over the phone, providing you've passed all the proof of identity requirements, or you can do it online through MyGov ID. And that's part of the reason why, as your accountant, we're not able to assist in applying for the director ID, is because there is that requirement to prove your identity. That's not something we're able to do on your behalf, and that you have to do directly yourself. Now, it is possible to make an application to the Australian Business Registry Service for an extension of time to apply for director ID, and this application can be made before or after a director is required to hold their ID. Now, failure to have a director ID by the applicable due date, it can potentially lead to ASIC penalising you up to $13,320. So quite a big penalty. But the Australian Business Registry Services, they've indicated that it's very unlikely that they're going to be penalising people who are seen to be trying to comply with the law and obtain their director ID. These penalties are more in place if you're the director who is intentionally disregarding the law, potentially doing something dodgy, and not applying for your director ID. Now, lastly, today, I did want to cover off on something that I'm sure most people are aware of is, the increasing ability to be able to sign financial and legal documentation electronically, particularly during the height of COVID. This has definitely become, signing documents in this way has become more popular. What might be news to some is that only select documents are actually allowed to be signed via electronic means, and the Electronic Transactions Act governs this. So in the case of super funds, the Electronic Transactions Act does not actually apply to the full SIS Act or the Corporations Act. So the SIS Act being the Superannuation Act that governs all rules in regards to the super industry. So to give some context, in July 2020, the regulations that form part of the Electronic Transactions Act, they were amended to specifically allow for the use of electronic signatures on the fund's annual financial statements and tax returns. So only one specific section of the Act was allowed to have electronic signing attached to it. And prior to this, the fund's annual financial statements and tax returns, they were required to be signed via wet signature, so manual signing. So that was only a couple of years ago that change is being made. So what's happening now is that in an attempt to kind of bring all of these signing requirements into the 21st century, the Treasury Department has commenced their Modernising Business Communications project. So this project is going to look to amend the Electronic Transactions Act to include the full Corporations Act. So that's going to be phase 1 of the project. And then also the SIS Act, which will form part of phase 2 of the project. So in starting phase 1 of this project and effective from 1 April 2022, part of the Corporations Act has now been permanently amended to allow certain documents that are being signed by or on behalf of a company to be done electronically. So These documents, they're including trust deeds, minutes of directors or shareholder meetings, and director and shareholder resolutions. So what does this mean for super funds? If you've got a super fund with a corporate trustee, then you will be able to sign any of those types of documents. So the trust deed, the director meeting, or the director resolution, you're going to be able to sign them electronically. Now, in contrast, if you have a fund that has an individual trustee structure, this amendment will not apply to you because you don't have a company that's acting as trustee. So that means if you're wanting to update your trust deed and you have individual trustees in place, you can only sign the trust deed manually with wet signatures. So this does also mean that there are still several super fund related documents that cannot be signed electronically because they relate to another part of the SIS Act that hasn't been incorporated under the electronic transactions amendments. So some of these documents include the ATO trustee declaration, consent to act as a director, certain trustee minutes and resolutions, so that's around in-house assets as an example of those types of minutes, potentially even pension commencement documentation or member applications. And for member applications, it may depend on what the fund's trust deed says in that regard. So I think in all of this, the bottom line when it comes to signing super fund paperwork, if you're in doubt, sign the document with a wet signature, because at the moment it's a bit all over the place. But hopefully in the coming years it will all become a bit more unified in terms of how signing can be done. Now, while we are as well on the topic of electronic document execution, I think it's important to also stress the acceptability of an electronic signature versus a digitized signature. So it's been our experience that SMSF auditors are not accepting fund documentation that's been signed with a digitized signature. So that means basically it's a digital copy of what your manual wet signature might look like. And so the reason that this is happening is auditors are seeing it as a very high risk that trustee signatures can be used to sign fund documentation without that individual's consent or knowledge. And so we're strongly recommending that if you would prefer to sign super fund documentation in an electronic format, and the law actually allows you to sign that documentation in an electronic format, that it be done so via an electronic signing software. These softwares have certain controls built into their system that ensures all the signing parties have the opportunity to review the documents and sign everything accordingly. So it's all a little bit safer, and there's an audit trail that's easy to follow. So that concludes the superannuation update for this afternoon. If you do have any questions about the content that I covered in today's session or about superannuation in general, please don't hesitate to get in contact with me. My contact details are up on the screen, and I will just have a quick check if any questions came through. Doesn't look like there was. If you have any, think of any after, please, as I said, don't hesitate to get in touch with me. But otherwise, thank you very much for joining me and enjoy the rest of your day.